Let's start with, before we get to your call, today's action. Are you surprised after this week-long holiday and all of the geopolitical risks that we've faced while China's been closed for Golden Week that we are seeing some upside here?
Yeah, I think the markets are really supported by what is more fundamental, and that's monetary policy. So if you look at the whole world, they have resumed cutting rates. For example, you thought the line on the sand was zero interest rates, but the European Central Bank cut rates from -0.4 to -0.5. You have seen Reserve Bank of India cutting 5 times. Bank of China or Central Bank of China has cut 3 times, and of course the Fed has made a U-turn and cut 2 times. So that is really the supporting factor for stock markets and risk assets.
We're also, of course, really moving towards whether or not we're going to see some kind of trade deal reached between China and the US. And I think that's why we are seeing a little bit of optimism in Asian markets as a whole today. If we, though, see this narrow trade deal that Bloomberg has been reporting on, this is our MLive question of the day. What does a narrow trade deal mean for market sentiment?
I do not think the markets has, I would say, discounted a total comprehensive trade deal. It's going to be an ongoing affair, this trade war. But we think and we hope that rationality will prevail because, as you can see today, everyone is a loser. The uncertainty from the trade war has resulted in people questioning about the global supply chain, and that has impacted PMIs. Manufacturing PMIs has been soft, not only in China, but also in the developed countries in US.
So, Wey Fook, we had our previous guest, Cliff Tan from MUFG, saying that, look, this could just be a deal in name only, where we're not going to get anything substantive, as you mentioned. Does that mean that risk assets can still outperform for the rest of the year if we get that limited trade deal here? And do we have to at least remove the uncertainty of further tariffs being raised first?
Yeah, I think an interim trade deal may be helpful. Like I said, this is an ongoing trade war. It's not going to be resolved, overnight. The markets have, I guess, got accustomed to that. Really, what we need to see is fundamentals. And if you look at monetary policy, as I've said just now, and if you look at the valuations of markets, many have said that the U.S. stock market is expensive, but one has to look at it in respect to other asset classes as well. So if you look at bonds versus equities, then there is still a place for equities. In fact, there is very little choice left but to buy into equities because cash is yielding you negative, zero, bonds is approaching negative as well. So really the only game in town is equity markets.
Where are you putting your money when it comes to the equity market right now? Because last week it was all about the U.S. versus the rest of the world, and the U.S. is now catching up in this slowdown in the rest of the world. Is the U.S. still the best bet to place your money here at the moment?
Yeah, we like the U.S. and we like Asia. And the way we are telling our clients is to really employ a barbell strategy. Why a barbell and what is a barbell? Barbell to us is to take outsized positions in 2 areas of focus. Number one, on the growth side, buying into secular growth companies right on the tailwinds of an economy that is transitioning into a digital economy. And on the other side of the barbell strategy, buy into income-generating assets in the face of negative zero interest rates. And in this respect, we think dividend-yielding stocks will be the new bond proxies going forward.
Yeah, that's as we continue to see, I guess, this hunt for yield as well. I wanted to talk more about what you were saying in terms of the entry point for Chinese equities as well. Where are you seeing the I guess, movement to try and get some of your capital to work here?
Yeah, again, the barbell approach. So we like China large banks because you are buying at historical low valuations in terms of price to book, and yet you are paid a dividend yield of 6%. And we think it's a sustainable yield. And on the growth side of the Chinese market, we like the consumption story, we like e-commerce, the big technology companies of China.